So let's talk about one of the most exciting and, let's be real, one of the most confusing parts of any startup offer, stock options. We're going to break down what that equity in your offer letter really means. Okay, picture this. You get the job offer. The salary is great. The role is perfect. And then you see it, a grant of stock options. It kind of feels like you just won the lottery, right? But what does that actually mean? Do you own part of the company now? Is it cash? Let's figure out what's really on the table. So the very first thing we have to do is understand the offer itself, because that equity piece, it's designed to give you a real stake in the company's future. It's about making you more than just an employee. It's about making you an owner. All right, here is the absolute number one thing you have to get. A stock option is not a share of stock. Not yet, anyway. The best way to think about it is like a special coupon. This coupon gives you the right to buy a share later on at a price that's fixed today. The dream, of course, is that the company takes off and the real stock price goes way, way above your special coupon price. Now, you've probably also heard of something called RSUs, or restricted stock units. They sound similar, but they are a totally different ballgame. With an option, remember, you have to pay money to use your coupon and buy the stock. With an RSU, it's more like a promise that you'll just be given the shares later, once you've earned them. That means options have more risk. If the stock price never goes above your coupon price, well, your options are worthless. But RSUs, they're worth something as long as the company's stock has any value at all. So you accept the offer. Awesome. The next thing that lands in your inbox is a formal grant agreement, and it's going to be full of legal jargon and financial terms. But don't sweat it. We're going to cut right through the noise and focus on the parts you absolutely need to know. First up, the strike price. You might also see it called the exercise price. This, my friends, is the price written on your coupon. It's the fixed amount you will pay for every single share when and if you decide to buy them. And the best part? That price is locked in on day one. It never ever changes, no matter how valuable the company becomes. So where does this strike price come from? Is it just a random number? Nope. It's set by a really formal process called a 409A valuation. Think of it as an independent appraisal that figures out the fair market value of the company's stock. This is all done to follow IRS rules, and honestly, it's there to protect you from getting hit with some really nasty tax problems later on. And just to make it interesting, not all options are the same. The type you get really matters for your taxes. Most of the time, as an employee, you'll get what are called incentive stock options, or ISOs. These are great because they can come with some very nice tax advantages. Then there are non-qualified stock options, or NSOs. They're a bit more flexible and can go to people like advisors or contractors, but the profits on those are taxed just like your regular paycheck. Okay, so you signed on the dotted line, you get the key terms, so what happens now? Well, you don't get all your options at once. You actually have to earn them over time. This whole process is called vesting, and it's basically the company's way of making sure you stick around and help make the whole thing more valuable. By far the most common setup you'll see is a 4-year vesting schedule that comes with a 1-year cliff. What does that mean? Well, for your entire first year, you're on the cliff. You're not earning anything. But then, on your 1-year work anniversary, bam, 25% of your options vest all at once. After that, the rest of them just start vesting in little monthly chunks until you hit your 4-year anniversary and you're 100% vested. That 1-year cliff, it can feel a little intense, right? You get nothing, 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 and then a big chunk. So why do companies do it this way? What's the deal with the cliff? It really comes down to one word: commitment. The cliff protects the company. It stops them from giving away valuable ownership to someone who joins and then decides to leave just a few months later. It's a system designed to make sure that equity, that ownership, goes to the people who are really in it for the long haul, the ones who are dedicated to building the company. All right, here we go. This is the moment everyone is waiting for. The company's crushing it, the stock value is way higher than your strike price, and you're ready to turn those options into something real. But hold on, it's not quite that simple. There is a huge, very important catch we need to talk about: taxes. You absolutely have to be ready for taxes to show up at 2 different times. The first time is when you actually exercise your options, when you use your coupons to buy the stock. That difference between the market value and your low strike price, that's a paper profit, and the IRS can tax that as income even if you haven't sold a single share yet. This can lead to a giant tax bill you have to pay out of pocket. Then the second tax event happens way later, when you finally sell the shares. That's when your actual cash profit gets taxed as a capital gain. You have to understand both of these. It's critical. So, why? Why do startups bother with all this complexity? with options and vesting and cliffs and crazy tax rules? Well, it's about something much bigger than just a paycheck. It's all about creating a culture of ownership. So let's zoom out for a second and see what that really looks like. And that brings us to this idea of dilution. As a startup grows and raises more money from investors, it has to create new shares. That means your personal percentage of ownership is going to go down. It has to. Look at this table. Your stake might drop from 1% all the way down to less than 0.5%. But, and this is the magic part, while your slice of the pie is getting smaller, the entire pie is getting exponentially bigger. So the actual dollar value of your smaller slice can skyrocket. That is the game we're playing. Now, while this is basically the gospel in Silicon Valley, it's not exactly the same everywhere. In the US, it's pretty common for late-stage startups to set aside about 20% of the whole company for their employees. But in Europe, that number's usually closer to 10%. It just shows there are different philosophies out there. But that core idea of giving employees a piece of the upside is pretty universal. So after all of this, what's the one big thing to remember? It's this. Stock options are not a lottery ticket that you just sit on and hope to cash in someday. They're an invitation to be a builder, a partner, a co-owner. The work you do every day can directly increase the value of your equity. When the company wins, you win. It's as simple as that. It's a really powerful model, you know? It gets everyone in the boat, rowing in the same direction, all trying to build something that lasts. So the real question your equity is asking you isn't just, what am I worth? It's, what are you going to help me become? So, are you ready to build?